Let's look at just the broad macroeconomic situation. In fact, really the one thing which everyone cares about, which is Fed interest rates rising. There is this, I guess this is the big picture stuff for you, and I'd like to sort of see how you're going to respond to it in this fund, and then maybe we'll talk about other options in different types of funds, which is obviously Fed interest rates rises, then interest rates following that will rise generally everywhere. This is a bear market for all bonds, more or less, other than maybe arguably high yield. So first of all, do you see that happening? I mean, is there basically a headwind that you have to face? And what can you actually seriously do about it in the constructions of your particular fund?
Well, I think, the end of the bond market has been something that's been called for the last couple of years.
Yes.
We talked about great rotation, we talked about crashes, we talked about the end of the 30-year bond market, and it's all proven to be wrong. At the end of the day, investors need an allocation to fixed income. And the way the regulation is going, it's just going to get more pressing that the allocation increases. So I don't think the bond market is over. Are we closer to the end of the cycle than the beginning? Yes. How long could this part of the cycle or the recovery stage of the cycle go on for? Your guess is as good as mine. It could be another 2 years, it could be another 5 years. What we are in is in a low growth, low inflation environment generally across the globe. And that's why you saw treasuries rally so significantly last year. Now, the question is this year, with the first rate rise coming out of the US, will it or won't it happen? And how does one position for that? And will that provide the spark for a panic out of bonds? So to the first point, I think we will see a rate rise this year. Will it be in the middle of the year? I'm not so sure. I mean, obviously the momentum is very strong in terms of the US economic growth. Employment's very strong. We've seen a number of data points which still show that the US is recovering, irrespective of what's going on in the rest of the world. So you will see a rate rise at some point, probably sometime in the second half of the year. Mm-hmm. Will we have more than one? It's really going to be data dependent. The Fed's saying yes, the market's saying no. So there is that. There is a difference of opinion which we'll have to compress as we go through the year. So that's one risk. I tend to think that they'll do one rate rise and then see what happens. I think it's going to be very well flagged. So I think the market is already getting ready for that. Will the US Treasury curve widen as we thought it would last year? Yes, I do think it will do. So I don't think it's not going to shoot up significantly, but I do think we could see between a 40 and a 75 basis point move wider this year, which will then obviously change the dynamics of the index that we've been talking about. Mm-hmm. Europe, different situation. We're further behind the US, so we'll have QE at some point in the first half of the year. We're not going to see any interest rate rises for quite some time in Europe. So one could argue that the bond market in Europe is a better place to be. The only issue with that is obviously the US and Europe is linked. There is a correlation there, so each market will have an effect on the other. One thing that the investor base hasn't really got their head around so far is the fact that we are going into a more volatile world. Now, since the great financial crisis in 2008, we've had a very high, low volatility, high correlation world where everything's really gone up in lockstep because of QE and central bank intervention. Now we're seeing some of that QE coming off in the US. And that volatility has begun to increase. So I think that's one thing that investors need to be aware of. But again, that brings opportunity for active managers.
There are quite a few long-short debt funds available now, run out of sort of CCAVs and so on. Would you like to run one of these? Would this be a good idea? How would you structure it if you did?
I think it would be interesting from an investing point of view. I think the problem you have with these funds now is that the lack of liquidity in the market, really kind of limits you in terms of what you can do. It would have to be a derivative-based fund, I think, so CDS, because I think doing a long-short cash fund would be problematic at the moment, just because it would be very hard to borrow. And you've seen, if you look at the volume of trading in credit over the last year, it's halved. And that's really symptomatic of regulation and the fact that risk balance sheets at banks are much less, and investors are tending to trade less as well. So in terms of from a theoretical point of view, it would be very interesting, but I think from a practical point of view, it would be something that you'd have to do through the derivative market.
Okay, fantastic. Thank you very much, Andrew Lake.
Thank you.